All right, hey everybody, Jeremy here with Escape Velocity Trading coming at you for another market bias update report for Sunday, July 14th. So before we dive into market analysis this week, first off, want to look at trading performance from last week. I ended up taking another loss last week, ended up losing just a little under $11,000. You can see here, had 6 wins and 1 loss on my stock and options trading, made a little over $1,100. But on futures, I was 5 for 5 in the negative and ended up taking a drawdown just shy of $12,000, leading to just a little under $11,000 loss for the week. Now, the reason I bring this up is that it brings up a really important trading rule. If trading was all about just knowing the strategy and just knowing the setups and patterns to look for, everyone would do really well at trading. That part is fairly textbook. There is a correct way to identify and analyze the market, and there is an incorrect way. Now, there's a lot of flexibility in terms of what time frames you are trading and looking at, and you need to be clear of how you are approaching each type of trade that you enter so that you are analyzing it under that lens. But one of the main reasons that I wanted to create Escape Velocity Trading is to talk about something that was a massive hole in my own education when I started to learn to trade, and that is how to manage your emotions. Now, agree with this or not, I'm guessing you probably will. Money is inherently a very emotional subject. And especially for trading, when you see profit or loss, you experience the emotions of fear and greed, of FOMO, of missing out on opportunities, or taking a loss where you were really sure on your analysis. And it can be really hard to keep your emotions in check while trading, because if your emotions start to get out of whack, it can really detrimentally impact your ability to analyze the market correctly. It short circuits your ability to clearly see what is in front of you and to trade accordingly, and to not only identify trades that you either want to get into or to pass on, but also how you manage the trades that you get into. And I struggled with that this week. It is new to me to have a lot of exterior eyes watching my trading performance after launching Escape Velocity Trading, and I am learning to adapt to a little bit of that new pressure. And so in my own trading, I've noticed over the last 6 weeks, I have taken a drawdown of just under $20,000 in my account. Now, that might sound like a lot. I have worked really hard over the last 8 years to build my account up to the point where that is within a normal cycle of the ebbs and flows of the market. So while it's not something that I am overly concerned about on the day to day, I do have a personal rule that tells me if I take a drawdown of around $20,000, or, give or plus or minus 1 or 2,000, and I give that plus or minus only because it's not going to be a hard set 20, because if I get to what my drawdown currently is, which is 19,500, I believe, for the last 6 weeks, if I'm already in a trade and I have my set risk for that trade, I do not want to adjust my stop losses or adjust the risk that I'm taking on that trade if it is already an open active trade, because my analysis was what it was for that trade. So if I end up taking a loss on that trade that is open and it ends up putting me a little over that 20,000, that's okay. If I end up coming in at any point and have a drawdown around 20,000 and I'm just shy of that, I'm probably not going to open another trade for a little bit. I'm probably going to reset, try to analyze my past performance, see what I've been doing right, what I've been doing wrong, and hit the pause button long enough to let the emotion come back down, to be able to analyze the market clearly, to be able to see what you are doing wrong or where you can improve, and then come back fresh to the market to make sure that you are not just continuously digging a hole for yourself. So this last week, I did, like I said, end up taking another loss. This put me just shy of my $20,000 rule, where I tell myself, hey, I am going to take a pause, step back, analyze what I am doing, look for the places that I can improve, get a more accurate bead on what the market is doing, and then proceed. So talking about this role of emotions, there are a few different ways to control your emotions while trading. One of them is very simply using stop losses. You have to understand when you enter a trade, what is your max allowable risk for that trade? How much are you willing to lose? What is that number that is comfortable to you versus how much is going to make you lose sleep and make you kind of spin out? Because if you start to spin out in the market, there's only really one way to go. You are going to dig yourself a hole. So you have to have a game plan in place to stop that negative momentum, to halt that, to find a game plan to rebuild and to move forward. And usually that looks like scaling back your positions or taking a break entirely and then reassessing and starting to come back in with smaller position sizes so you are risking less until you get a read on the market and you rebuild the confidence from there. So I just mentioned this because one of the really big reasons that I actually decided to launch escape velocity trading in the first place was because in my own personal journey of learning to trade and through the mentors that I've hired, while they are incredible traders and I owe so much of my success to the mentorship that I've gotten over the years, there was a glaring hole in that education. They told me that managing your emotions while trading was really important, but they never expanded on that to tell me anything having to do with how to go about doing that. So I just want to put that there, and I will probably be making some more content on the YouTube channel here. It's something that I cover in depth in the course that I've launched. But I think it's important enough that I'm going to try to make a few videos to post out here on YouTube as well for you guys on how to manage your emotions while trading and the impact that that can have on your end results and how important that is. So with that said, I am going to close out of the trading journal here, and we are going to dive right into our market performance for the week ahead and see where we can be taking advantage of potential trades in the market. Now, this market is a little bit tricky right now. We are pushing all-time highs. We are obviously in a strong bullish uptrend. You have to expect, if you are in a strong trend, for the trend to continue. But we also have a lot of things going on under the surface, both politically and economically, that make me a little hesitant on my read, if I'm being completely honest. So let's start with the economic data. So going out, this is looking at the economic data that was released last week, and we got to see how the market reacted to that. So we had some testimonies by Jay Powell Tuesday and Wednesday. Market didn't really care one way or the other about that. The big thing was CPI and PPI data. And this is important. Our CPI data actually came in at 3% for the year-over-year mark. And if we look at the chart for this 3%, we have only had a reading of 3% one other time, and that was in July of 23, since basically going all the way back to May of 2021 or April of 2021. So it has been several years since we've had a CPI reading that has been that low. And the impact that that has, that is a inflationary reading that basically is a leading indicator of how the market is interpreting whether or not the Federal Reserve is going to be quicker to decrease interest rates, or if they are going to maintain the high interest rates that we have had, or even try to bump it up. If we had had a reading come in here at, let's say, 3.3 or 3.4%, rate cuts in the next couple of cycles would basically be off the table. But since we came in under the expected 3.1 and the previous month, and it was the lowest reading that we have had in a year, in the two lowest readings equal to each other this year and last year in July, since basically 2021, this gives a lot of support to the idea that the Federal Reserve might actually be able to decrease rates sooner than expected, which is bullish, especially for small cap stocks and companies that don't have the cash reserves on hand to be able to weather high interest rates. Again, like I said last week, small caps companies don't have the cash reserves necessary to grow their businesses usually. And so they have to rely on borrowing capital to invest into their company to grow. Whereas big companies like Google and Meta and Amazon and Microsoft and Nvidia and all of these big tech giants, they have plenty of cash on hand. So the interest rate doesn't impact them nearly as much. And as such, if we go out to the charts and we look at our Mag 7, so let's go out and look at that. This is our Apple, Amazon, Google. We can see that even though rates have been incredibly high lately, we have just been on exponential tears. We go out to Amazon, you can see it has been up. Google, up. Meta, up. Netflix, up. Nvidia, up. Even Tesla has come back online recently. And this shows the impact of them having those cash reserves. But if we go out, let's say to IWM, which is the Russell 2000 index, we can see that just the last couple of days, it has broken out of a massive neutral range that we have had for the last 6 months. And if we drop this out to a longer time frame chart, you can see that we have a long way to go to push back up to all-time highs, whereas all of those Mag 7 components, the big tech industries, and even the QQQ for the Nasdaq or SPY for the S&P 500, they are all already pushing all-time highs. So last week I said there was a potential for a really good catch-up trade in IWM, and unfortunately the train left the station quicker than I anticipated it because of that CPI data. So now we need to look for secondary patterns. Any kind of a high base here, a flag pattern pulling back into like 210 would look really good. But we are seeing a little bit more risk on scenario within those smaller, riskier assets. And that is going to be the place that we need to keep an eye moving forward. So with that said, now let's go out to look at the economic data for this coming week. And since it's July 14th, we're looking at the week for July 14 to 20. You can see on Monday, we have Empire State Manufacturing Index, Powell speaking, core retail sales and retail sales, and then unemployment claims. Of all of this, I think honestly, the one to keep your eye on the most is going to be the retail sales reports, probably month over month. And also, honestly, what Fed Chair Jay Powell says on Monday. I haven't really cared what he has said at press conferences outside of our actual federal fund rate meetings for a little while now, because he updates us on whether or not the Federal Reserve is looking at rate cuts and what their rate decision policy is going to be during those meetings. And then these speeches in between haven't had as much weight. But I think because of the CPI data last week, this is going to be really important to listen into and see what he has to say, and if he hints at all that they're even possibly considering an earlier rate cut. Because right now the market has been pricing in potentially a September cut or potentially a November or December cut. But July has been pretty much off the table for a while, and we are starting to see the percentages for July bump up. Even though this is only a 6.7% chance, this was basically a 0% chance a few days ago. So we are starting to see that ramp up and the possibility of a cut coming sooner than later. If we bump this out to September, you can see people are actually expecting, by a wide majority, 88% of the market is expecting a cut in September now. Just a couple of days ago, this was down in the low 70s, so it's jumped almost 20% just in the last few days coming off of that CPI data report. And this should highlight to you how important these economic data reports are when you are in specific environments within the market. When you're in specific economic cycles, it is really important to pay attention to these. And if these kinds of reports bore you, don't worry. It is honestly not something you have to pay attention to a lot while trading. There have been years at a time where I have not visited this website once, because this was not a conversation that had to be had. But because we are in a high inflation environment and the market is looking for cues as to when we might get a reprieve of that, this is really important to track. So I just want to keep this on the radar every week for you guys so you can be prepared for the market impact that these kinds of things have. So with all of that said, let's drop out and take a look at our futures and see what we are seeing in the charts here. So like I said, this is the futures version of the S&P 500. And like I said, for the S&P 500, we have been in a strong bullish uptrend basically all year. This is a 6-month chart, and you can see that we had a nice correction. We blasted off again, And honestly, even though the market is to a point now where it is signaling that we might get rate cuts sooner than we expected, I'm starting not to like where we are in the S&P 500 itself nearly as much as I did a few weeks back. And the reason for that is it is normal for markets to swing back and forth and for money to rotate from one section of the economy into a new section of the economy as the economy itself changes. And right now, we are on the precipice of a rate cut coming down sometime in the next 4 to 5 months, likely. And when that happens again, the small caps will outperform. And that means that people that have ridden this big bullish wave up in the S&P or going out to the Nasdaq might look to take profits and then roll it into things like IWM that if again we put out to a longer time frame chart, we can see still has quite a bit of room to catch up to push back to its all-time highs. So with that, S&P obviously still bullish, but not liking it quite as much as I have recently, still pushing a lot of overextended on the RSI. We do actually have potentially a little divergence forming on the MACD. Divergence is where you get a peak in the MACD and then followed by a lower high, whereas during that same time frame on the price chart, we had a peak and then a higher high. So prices are still going up, the momentum is still there, but the MACD is signaling that the momentum is actually slowing down under the surface, and there might be a consolidation here. So with that said, my base case is actually we will probably pull back to about 5,600. Anything deeper than that, honestly, I would love. I don't think that support zone is likely to break, at least in the short term, but I do think that we are likely going to see a little bit of consolidation, a little bit of pullback this week as money starts to rotate out of these areas that people have a lot of profits in and into other lower areas in the market that they see a higher relative value currently. Similar going out to the Nasdaq, basically rinse and repeat the exact same thing, except here we've actually seen divergence on both the RSI and the MACD. So both of these are showing divergence instead of just the MACD like we saw on the S&P. This tells me people might be rotating out of the tech sector a little bit, looking for a reprieve, and whether that is a time reprieve where time kind of goes sideways, price goes sideways, and then we build a new support and resistance zone that we can trigger above, or if that means that some of these shorter term support levels break down and we back out to a weekly time frame chart and look for major support levels. So here it makes some sense for us to come back into maybe the weekly 20 SMA and the overhead support and resistance zone right here around 18,900 to 19,000. Or if we just stabilize and create another base to then move off of. So right now, looking at potentially a little bit of pullback and consolidation in both the S&P and the Nasdaq. For the Russell, honestly, overextended. There's not much you can do with this chart right now unless you were lucky enough to catch this break. I was waiting for this diagonal break and loved the consolidation of this. I even called it out last week on Monday, the 7th or 8th, whatever that was, right in here. Basically said, I think we are really close to an opportunity here. Unfortunately, the market didn't give us a really clear entry until it just blasted off, and the train has now left the station. So what that means is we need to see some kind of consolidation pattern where we create a higher level of support and we create a higher level of resistance. And that gives us a window that we can trigger a trade on with a low risk opportunity. Or that means that we need to see some kind of secondary pattern with a little bit deeper pullback and then come back up, work our way back up into this resistance zone, and then break out of that zone. Either way, we're probably looking at a break above 2186 for the next tradable signal, but we need to see either sideways consolidation or a little bit of a pullback before that is going to be squarely on our radar. Moving out to crude. Crude light, basically just doing exactly what I was saying we needed to see in the Russell, more consolidation. We had a really, really strong run. We pulled back. We are currently holding our 20 SMA. We have given up the 9-period EMA, which is our exponential moving average, the shortest moving average that I track. And eventually a break above our diagonal resistance. If I put this out to a longer time frame chart, you can see a clear diagonal resistance line here. A break and close above that is signal for the bulls. But on the daily chart, on the short term, we need to see more consolidation and really build that breakout channel before I'm going to get interested. So right now, off the radar, except for potentially day trades, if we do close below the 20 SMA, my next stop down will be down to 80, so I might look for a short there if we close below 81.76. Otherwise, basically, patience plays on this and need to just wait it out. Going out to Bitcoin. Bitcoin is starting to wake up a little bit, and we need to put this out to a longer time frame chart to see why. And I'm going to clear my drawings here for you. So price came down. We consolidated in kind of a flag-based pattern on the monthly chart, bounced off the 9-period EMA here, and are now consolidating above that. If we drop this out to a weekly chart, you can see that we've actually broken our shorter term moving averages, both the 9 and the 20, but we are trying to come back up and test the 9-period moving average on the weekly chart. Basically today, that correlates to the 20 SMA on the daily chart here. So if we break above and close above that, the base case is going to be coming back up and retesting the 50-period daily, which is just over 64,500. Ideally, I would honestly love it if this didn't actually break out now. I want to see a little bit more development here on the lower end of the chart. So something more like this, where it comes back, tests the rising 9, lets this 9 EMA starts to curl up a little bit, acts as support and gets tested by a price decrease, holds, and then comes up and breaks out. And what that does is it allows this 20 SMA to slow down its decreasing momentum, allows it to flatten out. And then when the price breaks above this resistance line, it also breaks out of that moving average at the same time. And it would complete a little cup and handle pattern here, which is a bottoming pattern and a bullish signal. That would give a much better risk to reward, because if we just break out from here, we can't really stop until below this pivot, and that is a long way down. That would be a $4,500 risk for your stop times 5, because that is the risk of a Bitcoin futures contract. Now, obviously, you can play things like BITO, or IBIT. These are the ETFs for this sector. So if we did close above the 9 EMA here, that would be enough for me to probably start scaling back into longer term stock and ETF positions on this. But for my short term momentum trading, there isn't much to do here until we get a little development on Bitcoin. So ideally, I would love to see this pull back a little bit over the next 24, 48 hours, settle down and stay within a range of about 59,000 up to about 61.5, and then break out in a couple of days. If we get that pattern development, I am going to be really interested in buying this dip and starting to leverage a move not only up to the 50, but potentially trying to reclaim all of the losses that we've had over the last few weeks here. And just as a note, for people that don't track this industry as closely, a lot of this sell-off has actually been precipitated because the German government confiscated a ton of Bitcoin from an illegal website operation a while back, and they have just been liquidating it. But it was such a large amount of confiscated Bitcoin that the German government had that their liquidation of this took days and days and days. They have been liquidating a steady amount every day for several weeks now. And that selling pressure has led a lot of this selling that we've seen in the market. Now, we've had big blowouts like this candle here on 624 and another one on 7.5, where that selling pressure from the German government also ended up coinciding with a break of a significant level that a lot of people had stop losses under. And then that causes a cascading effect where everyone's automatic orders to sell to get out of positions if they are wrong on direction get triggered automatically, and it creates kind of a waterfall and liquidates a lot of people's positions all at once. So that's likely what happened on both of these candles. But if we can get that stabilization here, a pullback, and then a breakout of that 61,500 level, I'm going to be much, much more interested in Bitcoin. We are not quite out of the woods for this downward pressure in price yet. And if we go out to the weekly on it, you'll see that right now, this is just a bearish retracement. We had a wave down. We are coming back up and retracing part of that. And so as a pattern, this is nothing more than a bearish retracement right now, which signals that on the weekly time frame, more downward pressure may very well come to a theater near you. So it's not time to push the chips into the middle of the table yet, but it is on our radar on the shorter time frame, and things start on the shorter time frame. The longer term time frame is not going to work itself out and become favorable until we see the shorter time frames start to build a foundation. So keep this on your radar. Not quite time yet, but it needs to be on our radar for potential coming up in the weeks ahead. Going out to crude light. Oh, we already did crude light. Going out to gold. So gold's still in the middle of its consolidation range. Nothing has changed. Last week, I basically said anything between 23.50 and 24.50 would not shock me. We have basically ended last week right in the middle of that range. I am still calling the exact same thing. Anything in between that about $100 range on this is not going to shock me. I do like that we pulled up back above all of our moving averages, that our 9 and 20, the green and blue lines here, have started to curl up once again. And we did set a higher pivot low right here that we have now worked off of. I like that higher pivot low, the development of that in the chart. I wouldn't be shocked to give a little bit of a tilt to the upside for the bulls. So I'm guessing this week, if anything, we are going to close closer to that 24.50 line than the 23.50 line. But that is my current read on it. And then finally, let's just go out and look at UUP for the US dollar. US dollar breaking down, and this does actually benefit a lot of risk on assets, especially gold and silver. We did break down, which was really, really necessary right here. If we put this on a weekly chart, we were threatening to start a new bullish move here after breaking out of the highs of 29. That got snuffed, and we are now actually coming back down and testing that support. If that support level breaks and we see price go below 28.50, that is going to be very bullish for both gold and silver and a lot of the rest of the industry. So I'm going to be watching this chart on the weekly time frame very, very close over the next week or two to see if that 28.50 zone breaks. Again, we can also see that we have a little bit of divergence in the RSI here. We set a slightly higher high, but we set a lower high on the RSI. And that signals to us that this momentum may be slowing down. If we zoom in, we can also see that we have now broken our diagonal trend line for the first time in weeks. This is a 3-year weekly chart. So this gray line right here actually represents the beginning of the year. So since the beginning of the year, this is the first time we have violated our diagonal support line there. And that is a very strong change in character for the market. So pay attention to that. The last line in the sand is going to be if we get a close below the 20 SMA and then below that 28.50 level. If we close below 28.50, it looks like we are likely going to see lower US dollar prices, which again would boost our indices. So with that, guys, trade safe, focus on the smaller value plays above big tech right now, and let me know if you have any questions in the comments.